Jonathan, welcome to CFO at Home. Thanks for your time today.
No, thank you for having me. Pleasure to be on as your guest, Vince.
So, in my experience, when it comes to managing our money, I don't think there's a more important subject that we can discuss than gaining a better understanding of why we make some of the decisions we make and why we just do some of the things we do with our money. I understand that you professionally work with investors in order to help them better understand their money psychology. But before, and I do want to get into how this applies to investing. But before we go there, I really want to talk about this subject more broadly in terms of how our behaviors affect a lot of areas, particularly when it comes to our money. So I want to talk about some more broad areas that I think would not only affect investing, it affects all aspects of our money lives, and I would almost say aspects of our lives, period, but we'll at least keep our conversation in the universe of money. The first thing that I'd like to talk about is, and I think everybody who's listening to this has suffered from this. I've suffered from it. And even though I'm a money nerd, I've suffered from it. And it's procrastination. The way that even though so many of us will go into, let's say, a new year, and one of the things we're going to do, it's always variations of the same thing.
Yeah.
So we're going to get in shape, and we're also going to get our money lives in order. And we go into a year with the best of intentions, but really keeping that going, something holds us back. Something makes us procrastinate. And while we know these things are so important in our head, we just don't follow through with it. So, in your experience from a behavioral perspective, what are some of the things that you've identified that really keep us from not doing what we need to do and even just getting started and getting our financial lives in order?
One of the things is we talk about planning, right? And most people don't engage in planning in the exercise. And without really a plan, we don't have very high odds of success. Some people have said to me, "So you're telling me if I have a plan, you'll guarantee that I'll succeed?" And I say no. What I am telling you is that if you don't have a plan, that's the closest thing to a guarantee of failure. And why don't we do planning? And that leads to procrastination because planning I define it as a science of choices, right? That's what it is. If I want to retire at the age of 55 and I'm 30, I can work with someone like me who's in the financial business to do a study for me of my personal situation, how much I earn, how much I spend, and what's the principal sum, what's the amount of money that I need to get to by age 55 so that I could spend the amount that I need to spend. Let's say it's $100,000 a year when I retire. What's the principal sum? So I can tell someone that, but in then planning to get there, I have to also tell them those nice Starbucks that you buy twice a day. You've got to buy it once every 3 days because otherwise you're not going to be able to save what we need you to save every week. And so that's why we procrastinate, because the planning as a science of choices, people don't want to make those choices. So rather than confront the choices, they just procrastinate and they just hope for the best, or they'll put all their money in Bitcoin, saying if I swing for the fences and I win, that will help me eliminate the need to do planning and things like that. But that to me is one of the biggest reasons people procrastinate. Planning is painful. And when it comes to pain and loss, human nature feels the pain of a loss twice as much as they feel the pleasure of an equivalent gain. And a loss is not just financial. Loss could be I'm losing my time. I'm losing my freedom to do the things I want to do or buy the things I want to do, to make a sacrifice for the future. So we don't seek out strategies that are in our best long-term interest 20 or 30 years from now. We seek out strategies that minimize short-term pain and maximize short-term pleasure. Those are often the opposite of the strategies we need to engage in for long-term success.
It's funny you brought up the subject of coffee, and I just came off of a business trip where every morning the first thing the group wanted to do was find a Starbucks. So people have such an addiction, not just to Starbucks, but just to certain pleasures in life. Yeah, I can imagine the process that would say, maybe I can't have that Starbucks every day. Maybe even subconsciously you're procrastinating because you believe that that's where this is going to end. It's all going to be about sacrifice. It's all going to be about giving things up. Do you find that if you can get people over that hump, that like a lot of things in life, at times at least, they have the worst case scenario in their head, but if they can get over the hump, they may have to give up some things, but maybe not quite as much as they want it to. And also, does the comfort of having that plan and knowing that although I've given these things up, I'm getting something from another side. Do you work with clients that kind of at the end of the day that all balances out?
There are, sure, everybody's different, and that's how we can tell if we can help them or not. So if we start talking, I always say that the phrase I'm sure you've heard before, that the perfect is the enemy of the good, right? When we try for perfection,
Yeah.
we fail to even accomplish good. And so, to your point, if somebody's saving zero and spending everything, and worse, not just spending everything, spending more than they have, going into debt, and you can help them to at least get out of debt as a start, right? You've helped them. They're in a better position to be able to someday maybe retire. And then after that step is met, if they're willing to, okay, now that I'm out of debt, I'll start saving $100 a month, whatever it is, getting them into those habits. So the answer is yes, you can compromise with people, but they have to be willing to be helped, right? If somebody's not willing to be helped, all the things you can tell them won't penetrate that resistance. And I think that there's a term in the behavioral space called hyperbolic discounting. And what it means is that when we have a consequence, a negative consequence that we understand we're going to face someday, if I don't change my current behavior, right? If I don't stop eating bacon cheeseburgers every day and I'm 25, I'm probably by 45 going to have a heart attack. But the longer that negative consequence is, there's an inverse relationship between the length of that consequence and the willingness to change my behavior currently, right? So the longer away it is, the less willing I'm going to be to change my behavior today. And it works that way with planning too. If someone says, if you keep buying these Starbucks and you're 25, you're going to retire at 90. You say, you know what? I'll worry about that when I'm 90. We discount that negative outcome because it's so far away, and I'm just going to keep enjoying what I enjoy and worry about that when I'm closer to 90. And of course, it never ends well.
And particularly with money, that can be so impactful because time is your friend, particularly when it comes to investing. So, the miracle of compound interest, et cetera, et cetera. So I can see how that very human tendency, particularly when it comes to money, can be very impactful. The other broad area that I wanted to talk about is spending habits. Now we talk a lot about overspending, but and I do want to get your comments on that particular behavior. I also want to get your comments about the opposite, which is not so much underspending, but perhaps being even overly frugal. I don't know if there's one answer to both of those or if those are separate questions, but I'd just like to get your general thoughts on what drives those behaviors.
Yeah, certainly overspending is usually a quest for happiness. So one of the things I always teach people, this doesn't matter what much wealth you have. To me, the real definition of wealth is not a number. It's for whomever we are and however much money we have. Wealth is the ability to wake up every day and do what I want with whomever I want for as long as I want when I want. That person is wealthy, and that's a different number for everybody. And the reason people spend more and more is because it's a physiological thing as much as anything else. You get a dopamine rush. That's the pleasure chemical in our brain. And we don't get it from buying the nice car or the nice new piece of jewelry or whatever it is. We get it from the anticipation of getting the new thing. And so once we get the new thing, it's not really what our brain wanted. The brain wanted that rush of the dopamine drug, which only comes in anticipation of getting the new thing. So I get the new thing, I get the dopamine rush, and now I have the new thing, and that's why it's never as good as we think. It doesn't feel. I had it for a week already. Now I want something else. The reason you want something else, your brain wants another dopamine rush. So you're gonna, if you can't control that, you're never gonna be happy because things aren't what you're really craving. So now you have to figure out how to fill that gap. And there's one equation I always have. And again, however much money you have, it's what do I have? What's my current situation in life financially minus what are my expectations? And if I succeed in life financially, whatever that means to anybody, to get the freedoms I talked about, doing what I want, when I want, with whomever I want, for as long as I want. If I succeed with that, but somehow I keep moving that goalpost of my expectations, I thought I'd be worth 500,000 retirement. I'm worth 700, but I want to be worth 1,400,000. So I'm going to keep moving the goalposts. When you live like that, it's like living in a world with no progress, because no matter how well you do, you keep moving the goalposts. And so that's another important thing. So that explains, I think, why we spend too much. But on the flip side is, why do we spend too little? I think oftentimes that's also a human nature kind of survival mechanism. So when we were hunters and gatherers, you'd gather up a bunch of food. You didn't eat it all at once because you didn't know if tomorrow the lion would be out there and prevent you from going and getting enough more food. And so those people are, for survival, looking to constantly prepare for the next meal and not eat it all at once. And so I think all of these things are related to how we're programmed to survive. And so that's probably a reasonable explanation of why people don't spend enough. And a lot of times that also could be not just, I just described a nature reason, right? It's our human nature survival, but there's also a nurture reason, right? If somebody grew up in a generation where their family suffered economically and had something and lost everything, or if they grew up with someone who the grandparents suffered through the depression and ingrained in them that this can happen to you at any time. So make sure you have enough money. Save. So it's a combination of the human nature that I described, element of survival, and then the nurturing element of being exposed to somebody who had bad experiences with money. And by the way, that's what I call regret aversion bias through osmosis. What I mean by that is, regret is one of the most powerful, if not the most powerful, emotion that causes us to make certain decisions about money or anything else. And so if that person's family engaged in activities where they didn't save enough, and so they ran out of money during the depression or some other business venture or whatever, they saw how much that was painful to their loved one. And so that regret, the fear of regretting that might happen to them, is so painful that they do what's called status quo bias, right? Just don't spend the money, leave it where it is, don't buy things. If I leave the money where it is and don't spend it, then I'll never have the likelihood of having to face that regret like my parents did.
So appreciate the thorough answer. I wrote down 3 bullet items out of everything you said: happiness, which you mentioned, survival, and guilt. That's my takeaway from what you just shared with us. The happiness thing is interesting. I really like the way you describe that, the dopamine hit of purchases. So when it comes to happiness, it's, are we going to settle for the dopamine hit? And I imagine that that's just like any substance. That first high is the best. And then you're just chasing that first experience, and you can't recreate that anyway. So do you want to spend your life chasing that first high of the anticipation of the first time you bought that new car or that nice house? Or do you want to pursue the longer lasting happiness and realize, like you said, that really wealth comes down to choice and freedom and time independence to the greatest extent that you can get there, not necessarily the dopamine hit. So if we can reprogram ourselves to understand which path is the path to lasting happiness, I think that's maybe a way of looking at it. So I appreciate you sharing that. And as far as the opposite, I have to admit, I lean towards being frugal. So I do appreciate the words that you shared there, because sometimes that is definitely my issue. And I think some of the things you said ring true for me personally. So I appreciate you sharing that.
Yeah.
I'd love to turn the conversation now to your area of expertise, and that's investing. A lot of the things that we've talked about so far, again, apply over a lot of different subjects, and I think those principles apply to investing as well. But I'd like to talk about maybe some of the other common behavioral barriers that you work with people getting over, not only to start investing, but you also be a disciplined investor, because investing is not only, you have to get started in anything,
Sure.
but investing in, at least in my experience, is a decades long and to a certain extent a lifelong discipline. So it's also managing your behaviors for the long run, not just getting started. So are there maybe a top two, three items that you could lay out in terms of maybe the most common behavioral errors clients make?
Yeah, sure. The biggest thing behaviorally is there's really three common behavioral mistakes that everybody makes when it comes to investing. One is they're afraid to invest properly because of how they've been acculturated to believe investments work the wrong way, and that dovetails with their biases that actually feed into the poor teaching. For example, we have been taught our whole lives, investors have, people have, that your biggest risk in investing is if you buy into companies through owning stocks, right? Owning an interest in Apple Computer or Microsoft or Merck, the drug company, whatever it is, that your big risk is the market crash. The market's going to go down and you're going to lose all your money. And in fact, what the industry terminology for that is called volatility, which are just up and down movements around the long term average returns that one can expect, 10% a year over long periods of time or so. And the problem is when the industry defines risk and safety in terms of protecting your money, your $100,000 from fluctuating. So if the market goes down 5%, it's now 95,000. You say, "Oh my God, I'm going to lose all my money." But the real definition of money, and this is a big mistake, is not what people think it is. If I hold up $100 bill, for example, that's not money to me. That's a currency unit. It's a medium of exchange. So when I go to the bagel store, I don't have to say how many dishes do I have to wash to get a dozen bagels. I give them the $100. They give me change. It's a medium of exchange. But what people think it is, smart people, successful people, educated, uneducated, they think that it's money. And the only rational definition of money is purchasing power. Purchasing power, meaning the cost of goods and services goes up by 3% a year. If I have a $100 bill and I perfectly preserve it for 30 years, I think I've done okay because I didn't lose it. But in reality, in 30 years, because of inflation, I need $250 to buy what that 100 bought today. So I've lost really money, my purchasing power. It's all gone. And so the fluctuation of the number of dollars should not be a concern. That's every investor's primary concern, and why they avoid investing in companies in real assets, which is the only thing you can invest in to fight the disease of money, which is inflation, the cost of things going up. And by trying to control that illusory risk, it's an illusion of movement, volatility, what they do is they add more investments that don't move around. So instead of owning great companies, they buy what are called bonds, where they loan to companies, right? So the company will pay them 3% a year in exchange for them loaning the company money. The problem with that is every dollar in a bond, if you put a dollar in a bond today or $100 in a bond and it pays you $3 a year and you hold it for the 10 years until it matures, in 10 years you still only have $100. It's frozen. And by the way, the 3% that you were making on it, which is $3 a year, was also frozen. In year 10, you're only making $3. You need $3.80 to buy after inflation what you need to buy. And so that's one of the big problems is the industry teaches people and academia teaches people that when you're investing, the risk is volatility or movement. And you want to control the movement of the number of dollars. No, you want to control the elimination of purchasing power from each one of the dollars. The number of dollars temporarily fluctuates. The stock market goes down, it doesn't only recover, it goes on to new highs, right? So the number of dollars always, historically, always has come back. But the erosion of the purchasing power, at least 3% a year of each dollar, never goes back. It's gone permanently. And so that's one of the key behaviors that affects everybody. No matter how much money you have, you're afraid of the wrong things. You're defining your problem the wrong way. My problem is getting into investments that fluctuate, and I got to minimize fluctuation, so I'm going to buy the things that freeze my money, which kill my wealth. And so when you misdefine the problem, the solution is always going to be the wrong one. And in this case, not only is the solution the wrong one, it actually is the only way that you can run out of money reliably in your lifetime.
Yeah, that is a lesson that I learned very early in my investing life, my first handful of years working and having access to a 401k and talking to some of the old heads around the office and kind of expressing to them my concern about the money that I was putting into my 401k and I'm putting it at risk, blah, blah,
Right,
blah.
exactly.
And they spell it out to me in a way, in the way that you spelled it out, and it's in order to keep up with inflation, in order to make sure that I have enough money in retirement. There are only so many things I can do with it. This is more or less the path. It was that, yeah, okay, I have no choice. So then it was not risk. It's this may work out and it may not work out, but if I don't do anything, and I think you referred to this earlier, I'm sure to fail if I do nothing.
Yep.
So it was, yeah, I'm taking a risk, but what choice do I have? And it
But
was kind of a
also,
freeing thought.
it's also because, again, we're mistaught what risk is. So it gets very deep, but I teach every investor that I work with to rethink of risk. In other words, they say, I don't want to take too much risk, but I have to take risk. That's how they justify buying great companies. But if you understand that risk is not volatility, then they're not at all taking risk by buying great companies. They're eliminating risk, because risk is the chance that your last dollar might leave you before your last heartbeat. You're going to run out of money before you run out of your life. And that's risk. When you understand that, and you understand that that losing the value of your purchasing power is the other major risk, then you say to yourself, investments that lead to the freezing and destruction of my purchasing power are risky. Are they not? Those are risky. Those are bonds. Bonds are risky. Investments that lead to the protection and growth of my purchasing power, great companies that can pass on cost increases to their clients and innovate and continue to grow with the population, those are investments that are safe because they're protecting and growing my dollar's value in the face of inflation, much greater than in the inflation rate. Those investments called stocks, those are safe. So it's not that we're taking risk to get to our goals. We just don't understand the true meaning of risk. And that's the problem. We've been brainwashed to think that temporary declines are associated with investing in great companies are risky. It's almost the equivalent of saying that a temporary loss is the same as a permanent a temporary decline is the same as a permanent loss. That's the equivalent of saying that volatility is risk. It just doesn't. It's not true. It's not true.
Yeah, and this type of conversation is evergreen. It applies no matter when you have the conversation. And I'll just say at the time we're having this conversation, it applies as much now than ever. I'm not going to timestamp our
No,
conversation,
you're
but
right. This is
yeah,
timeless
yeah.
stuff. It's always this way. It's the way the world worked for the last 200 years, and it's the way it's going to work for the next 200 years. And human nature is immutable, it doesn't change. So, all of the things that we do to help people are going to be as relevant in 100 years, and AI can't take over for it. So, it's so critical. It's so critical. So, I'd say to your audience, the most important things to do: start fighting the urge to avoid planning by simply sitting down and facing it. Set a goal, whatever the goal is. Set a small goal. Say, my goal is in 6 months, I'd like to have $500 saved at Fidelity, where it's in the largest companies in America and the world, called the Standard and Poor's 500 Index Fund. And let me just put in, to get there, I'm going to commit to paying myself $80 a month. Start with something and get into the habit of saving every month. Then take a look at your expense column, all the items on it. And if, for example, I just talked to someone that have cable TV, they're paying $280 a year. I asked them if they ever heard of YouTube TV. You can get it for $80 a year. You could save $200 a month, $80 a month, right? You could save $200 a month from the cable bill and still enjoy watching the same stuff. And it's just a question of going through your items like that and say, no, I'm not going to stop my life. I'm not going to go from 60 to 0 in 3 seconds, but let me see where I can cut. Take small steps. Start with small goals. And it's like in the military, they call the small objectives missions. And you do many little missions to accomplish the bigger goal, which is called a campaign. So in this case, the campaign is, I want to get to X amount by the time I'm 55. What are the missions I need to do to get there? I need to save properly. I need to make sure I do some monthly savings because compounding is my just average return to the power of time. The longer I make those returns, and the more that my 6 7% I made last year makes, if it was a dollar, it's $1.07. Now $1.07 makes 7%, and then the $1.07 becomes $1.12, and that makes the 7. And so that the time does all the heavy lifting. You don't have to find the greatest investment. You have to get good average returns for the longest period of time. And so if you start early and you start with small missions and define your campaign, the ultimate objective, that's the best advice I can give to the people I think that are listening to this. As painful as it is to face it in terms of face planning and making choices, it's you're just delaying a much greater pain if you don't do that later on in life.
I love it. So I think if we go back to the beginning of talking about investing, you mentioned that there were three common flaws. I'm not sure.
Yeah,
Do we
when I
cover all of
no, when
those?
I so I'll go into those a little bit. I don't want to get too in depth with the audience for what they're looking for,
Yeah,
but
perfect.
one is a physiological flaw. It's something, in other words, that's autonomous that we have no control over. It's not psychological. At the base of our brain. There are these two organs, walnut shaped, called the amygdala. There are fear sensors, fight or flight, and they were developed over millions of years to protect us against life and death threats. So, like when we were hunters and gatherers and we knew there were lions, we would watch and see when the lion comes out, watch when they go home, and then we know what their pattern is, so we know when it's safe maybe to go out and hunt ourselves. And but the amygdala, when it hears a lion in the bush, it goes off, it sets an alarm, and it tells you to run. And the problem is for investors, we don't face life and death threats anymore. And the amygdala, as advanced as it is, it's the most developed and advanced that there could be because we evolved from the people who survived. So their amygdala was the best. So ours is now the best and most sensitive. And so it doesn't distinguish between a bear coming to get you in the woods or a bear market, a market that goes down 20%. It sends off the same signal and it tells you as an investor to do the opposite of what you should do. You should run from the bear in the woods. You should ignore the bear market, the decline that's temporary, and if you have any money, add to it. You should actually go toward it. So it's the opposite of what our human nature physiologically is telling us to do when it comes to
Right.
investing. So that's physiological. The next thing is a cultural thing. So when we're processing any economic input, we generally process them in a way that's called counter cyclical behavior. What is it counter to? Our demand for a good and service, any good and service, is counter to its price. If the price of something we want is going up, our demand is counter. It goes down. We want it less. If the price of something is going down, known as a sale, our demand for it is the opposite. It's counter. It's going up. We want to buy more of it when it's on sale. And we behave that way with every financial and economic input except one, and that's the price of company stocks. When stock prices are high and rising, human nature thinks that buying at the higher prices is less risky than if you were able to buy at lower prices. And they think the future investment return they're going to get by buying at the higher price somehow will be greater than if they paid a lower price. When great company stocks are on sale, human nature thinks that buying at the lower prices is more risky than buying at the higher prices it used to be at, and that my future return on the cash flows that I'm buying into are somehow going to be lower if I pay a lower price to buy them. And reality isn't just different than what human nature thinks in this regard, economically, how we process the price of stocks. It's the opposite. It's the opposite. In just that one way, we don't behave countercyclically, meaning our demand is opposite of the price. It's pro-cyclical. We're attracted to higher prices and we're repelled by lower. It goes in the same direction on demand as the price. And so that's the second. And the third thing is just psychological. And I covered one of them or two of them, like regret aversion bias. If we're afraid of a certain outcome repeating one that we hated in the past, we'll just accumulate cash instead of investing because status quo, if I just don't invest it, leave it in cash, I'll never have that bad outcome when I invested in technology stocks 20 years ago and lost all my money. So I'm just going to leave it in cash. That's regret aversion. It causes you to go status quo bias, leave it the way it is, and fail to accumulate the purchasing power that you need over a lifetime. And there's many psychological components, but those are the three: the physiological, the amygdala, the fear sensor, the psychological, and the way we process economic inputs as it relates to investments.
And Jonathan, I want to thank you for sharing all of that wisdom. I know that the firm that you work for, Fusion Family Wealth, you really work with high net worth individuals. So it's great to get that type of information, the same information that you're sharing, the same psychological tips that you're sharing with people who have amassed millions
Yeah.
in their portfolios, and share that with my audience. So I really want to thank you for that. And before we let you go, in order to continue to get a little taste of your wisdom, I do want to bring up your podcast, Crazy Wealthy Podcast. Tell us a little bit about that.
Well, Crazy Wealthy Podcast, I have a monthly interview similar to what we've done in this interview. And then I have a monthly 10 or 15-minute monologue where I actually use real life stories to identify faulty thought processes that we use when we're dealing with money decisions under conditions of uncertainty, and how to overcome and address those faulty thought processes. So those are called Fix It Friday. They come out once a month on a Friday. And on my website, crazywealthypodcast.com, people could see all of the episodes that we have. We've been doing this for a few months. We've probably got 12, 14 episodes now, and they're very instructive, regardless of how much money someone has.
All right. I love it. A perfect companion to CFO at home for all of our listeners. Jonathan, hey, I really want to thank you for your time. Again, this is the type of wisdom that I love to bring to my listeners. There's a lot of talk in the financial space about the secrets of the wealthy, and I always say that, hey, it's not so secret. So again, you have shared the same tips and guidance that you share with air quotes for people who listen to the audio version for the wealthy, and you've shared it with my audience. Thank you for your time. Thanks for being on CFO at Home today.
My pleasure, Vince. It was very nice to meet you and appear as a guest, and hopefully help your audience with some helpful thought processes.